Hey guys, I hope you're all doing well. Welcome back to a new video. It's your boy Luke here from ZCFX Trading as always. Now in this video I'm going to be discussing the differences between a breaker and a flip zone, and what is the difference between the two and how to spot the difference. And also I'm going to be showing you guys some live examples as well as always, so make sure you stay around and check that out later. Now also, before I jump into the video guys, I want to mention I am running a discount on my mentorship, so if you are interested in that, make sure you go ahead and send me the word discount. You can send me a free email or any of my social media platforms of Discord or Telegram, and I'll go ahead and send you the instructions on the code on what to do next. And yeah, it's a nice discount. I definitely recommend you check it out. If you are interested in jumping on board, guys, just do it. Honestly, the best investment you can make is in yourself, so if you are interested in that, go ahead and do it. Because I've got real results, real students in Discord, you know, many become funded, many become consistently profitable, and vice versa. So, you know, if you are willing to put in the work and work with myself and go back and forth with the questions and the DMs and things like that and one-to-ones, you'll definitely succeed, guys. There's no reason you won't. So if you're interested in that, guys, go ahead and check it out. The idea is to sort of try and get you consistently funded, you know, consistently profitable and funded trader within 12 months. So there's going to be a roadmap laid out for you guys. And also I'm working on some other future things as well at the minute, some webinars that will be coming out. So guys, if you are interested in getting involved, make sure you do, because I highly recommend that you do. Now with that out of the way and being said, guys, let's jump into the video. So when it comes to a flip zone, let's just say that we're in a bullish market, right? So in a bullish market, price moving, you know, higher, we're creating higher highs, higher lows, and obviously when it comes to supply and demand, demand's being respected and supply is being violated, as we know in a bullish market, vice versa in a bearish market, prices, you know, respecting supply and violating demand. In other words, respecting an order block, so mitigating an order block and violating the order block you want to sell from, but you know, respecting the order block you want to buy from in a bullish market, right? So when it comes to supply and demand, I've simplified my trading. I trade from order blocks and breakers, but I just simplified it to supply and demand. If I'm looking to sell, it's my supply zone. If I'm looking to buy from it, it's my demand zone. So the whole way of my trading is just simplified to the absolute, you know, fundamentals really. It's a very simple process. So when we're in a bullish market, obviously, like I said, demand's been respected. So that's exactly what we want to see here. Now, when it comes to a flip zone, guys, it's very important that you listen up here. The differences between the flip zone and the breaker is that there's the flip zone here. When it comes into the demand area, it reacts short term and it fails to take out this high. So this can be classed as a failure swing. So you got number one is react short term. Number two, failure swing. Okay, I will jump into what a failure swing is in the separate video, but it's pretty self-explanatory. It fails to take out a high or low. Very simple, but I will go more in depth about that and show you guys some examples as well, because it does provide some opportunities based on the failure swing alone. But the key here is, guys, it must short-term react before violating that zone. And rather than a breaker where you drag it to the right and extend the zone, well, I'll discuss that more in a minute, you want to mark up the zone that created the break, and then you ideally want to trade from that zone, and then obviously look to go short there with a nice kind of combination or whatever the you know, your entry process is. But yeah, that's very, very simple. So number one is that it must react short term. Number two is that it fails to take out the high in this case, and obviously in the bearish market it fails to take out the low. So if we were to just flip that, as you can see, bearish market, supply is being respected, we come up to the supply, mitigate it, short term reaction, we fail to take out the low, we then violate this zone, and then we mark up the supply zone, the demand zone that took out the supply. Okay, so that's all we wanted to do, is you wanted to trade from what caused the break. So again, fails to take out the high and short-term reacts. Those are the two things that validates a flip zone. And like I said, guys, I will go over some live examples at the end of the video. I'll throw in some as well, so make sure you stay around and listen for that as well. But yeah, those are the two key things that validate a flip zone. And obviously, you know, these are higher probability sort of POIs to trade from. So if you need help in POI identification, then this is the video for you guys. So yeah, definitely this is the you know, flip zone definitely does provide higher probability setups. So if you do see that in the markets, and obviously it lines up with the high time frame, you've got session timing behind you as well, the momentum's on your side, then it's going to be a higher probability setup to go short from in this case. Okay, so you're trading from the zone that caused the violation, or you know, the break below the demand zone. Okay. And what I will do as well, guys, is before I end this video, I'll pop up on the screen a detailed annotated chart so you can screenshot it. I'd highly recommend you do that, and I'll try and post a link down in the description for it as well, but I'd just recommend just screenshotting it. I'll post it on the chart, not this one, but in a minute after I finish going over the breakout, and I'll just show you the differences just annotated. Now, moving on to a breaker, guys. So remember the key two things. Remember that. Make sure you write it down. And moving on to a breaker now. Anyways, let's just say we're in a bullish market. You know, it's a bit of a. It'll just click and it'll make sense. So in a bullish market, again, as we know, demand's being respected. Okay. Now let's just say we have a demand zone here that we're looking to long from. Obviously, you know, in a bullish market, you can keep looking to buy and buy and buy until obviously the trend. It's like they say, as cliche as it sounds, I hate saying it, but the trend is your friend until it ends. It's very true, but it's very cliche to say, but it's very true. But you know, people just they're always caught on the wrong side of the market. That's why I always stress, and I can't express enough, to trade what you see and not what you think. You should be trading what you see on the charts, not what you think is going to happen. You want to be trading what you see, pretty much. So price being bullish, it makes sense to just keep buying, and then eventually, yes, you will take the loss, and the trend will end and it'll flip bearish. But so what? Okay, if you stuck to the plan and didn't FOMO out of any trades, you would have caught some nice trades. But anyways, as you can see here, right, the ideology behind a breaker is that it violates the zone. Okay, it doesn't react. If it does react like this, for example, let's just remove this one here. If it does react short term and then violates it, the breaker is the differences between the flip and the breaker. Is you're not marking up the zone all the way from the extreme that caused the break. You're marking up the same zone that you use on the flip side. So when in a bullish market, you're looking to buy from this demand, and now you're looking to sell from the same that was previous demand, but it's now turned supply. So that's what a breaker is. It's you know, you're just extending the zone to the right. So when your zone that you have marked up gets violated, if you leave that same zone marked up and just extend it to the right, you'll often find that it'll be respected later on in the day. So it can sometimes react short term, sometimes not react at all. It doesn't matter. But the ideology is you're just extending that zone to the right. And then what we're looking to do is we're looking to trade from that zone and then look to go short based on your confirmations. So that's exactly what a breaker is. So the difference is that it doesn't sort of, you know, well, I guess you could say sometimes it does react and then break, but the difference is that you're trading from the same zone that you had previously marked out on the flip side, but you're just having it now on the same, you know, the now side of the market. So in this case, there's a previous bullish market, respecting demand. We had a demand zone we were looking to buy from, but unfortunately it didn't hold. It got violated, and now on the flip side, we just broke bearish. We just got a closure below the lower high, you know, in this case a higher low, and we're just looking to trade from that same zone, but we just extended it to the right. That's all the difference is. And on a flip zone, you're not trading from the same zone, you're trading from the zone that caused the break. That's the difference. So that's, you know, these are higher probability, you know, POIs to trade from, because when you're marking up a flip zone, it's an extreme zone, right? Well, not all the time, but a lot of the time it's an extreme zone. So this leads me to tell you guys, when you're trading breakers, it's better to catch them in higher sort of volume markets. So when, you know, around London Open, New York Open, you'll see quicker paced movements in a shorter period of time. So those, in that case, is definitely better to trade from breakers, because, you know, prices, quicker pace is not going to pull back to the extreme as opposed to a sluggish market, a slower market. Not necessarily a sluggish market, but necessarily a slower market compared to, you know, a nice impulsive trending market, right? So again, the difference is that the flip zone, you're trading from the zone that took out the zone. It also must react short term. That's what a flip zone is, and it fails to take out the high. Breaker, very simple. If you have a zone marked up, it gets violated, you just drag it out to the right and it should get respected. What not should, nothing's 100% in trading, but a lot of the time you'll see it play out. So if you go ahead and, you know, not necessarily back test, but just review previous price action and mark up all the valid zones, you will see it gets respected on the flip side. Okay, so definitely recommend, if you haven't already, go ahead and check that out on the charts and see what the differences are. But I'm assuming a lot of you people looking at this video, you probably already have an idea on what a breaker or a flip zone is, so I don't need to go crazy in depth. But one thing I will mention is breakers that are through an imbalance have a higher probability of holding compared to breakers that don't have an imbalance. So what I mean by that is, let's just say you have an imbalance here, so you got this imbalance here. The break is through that, as opposed to there being no imbalance. Okay, so that's higher probability to be trading from a breaker that has an imbalance as opposed to no imbalance. So just remember that, guys. And that's pretty much the differences and the key differences in exactly what a breaker and a flip zone is. So guys, make sure you go ahead and write that down if you need to. And yeah, what we'll do is we'll jump onto some live examples. But before I do that, guys, I'll put a pop screen on chart now, and make sure you go ahead and screenshot this, guys. It'll just be on there for a few seconds. I'll leave it on here. Make sure you go ahead and screenshot this, guys, and keep it saved in your journal, and even write it down if you want to recreate your own sort of style. But that's what a flip zone and a break differences are. But guys, thank you for watching. What I will do is I'll go ahead and throw in some live examples now, so go ahead and check them out and enjoy. So here's just one example of a flip zone. So as you can see, again, price moves, whichever way it does, goes back down to the zone, reacts to it short term, violates it, and then pulls back to it later on, like that. So as you can see here, we've got this low, we've got this zone here as well. Price comes into it, which you can see here, reacts to it short term with this wick, and then breaks the zone. Now there's quite a more difficult sort of example, but still a valid example. Now, as you can see here is a break and mitigation. So like I said, sort of more higher volume, markets, more momentum you start to see in the markets as well. As you can see here, we heavily violate this zone, came back down to it here. So as you can see, broke below it, wicked into it, and then that's a mitigation. So that's what I was trying to explain earlier, rather than waiting for price to pull back into it from here. This here is perfectly fine to pretty much trade from. Then what I will do is I'll show you the entry time frame. That is where my entry was. So price tapped into it here, so we came back below, came back up into this sort of supply area, broke it again inside of 1 minute bearish range, zone, broke it again, reacted zone. So we've got a nice supply chain here as well. And then obviously the entry here was after you get bearish engulfing. Could have also entered here, but I think by the time I arrived to the chart, it was a bit later in the day, so that explains that. Now here's another example of a break and mitigation. These are trades that I'd take as well back in January, February, March time, 2024. But it's just sort of ones I shared in the community. So if you want to see more of them breakdowns, we've got loads of exclusive ones, so make sure you join up within the community as well. There's a lot of value there. Now, as you can see here, we've got a nice break and mitigation here. Price moving bearish. We see the volume start to kick into the market here. We break below with this zone here, or this body, sorry. We then wick back up into the zone, which was previously violated here, so we just dragged it to the right. And when you jump down to the 1 minute time frame, you can see we get a nice perfect entry here. Now we've got this high, and obviously we just mark up this imbalance to the overall high. Bearish engulfing candle starts below, just above or on par with this where high is, and just targeting into the higher time frame zone there. Now that was a perfect, nice example of a trade opportunity there as well, using the break and mitigation. Here's a little example on the flip as well. So as you can see, price came back down into this wick demand here, reacted to it short term, and then violated it. So what we'd be looking for is a little pullback into the newly marked up supply, which would be from this area, and then look to short down to high time frame zone. So that there is another example on WTI as well. And here we have another example of a flip. So as you can see, we have this bullish range here. Price comes down into the area, short term reacts here, then violates the zone, got a new range low and high, come into this new area of supply, and then obviously we should respect it and take out that low. Then we got a nice example here on a dollar Swiss as well. This is also another trade idea that I sent out to my community a couple of weeks back. Very nice trade. As you can see here, we've got a chock above here. I was expecting for price to just sort of fill this imbalance and just sort of mitigate this breaker. And as you can see, we did exactly that, and stayed up at the highs, came back down into it, and rallied to the upside again. So that there is a nice last example to sort of end this video. I'd also just like to apologize, guys, if I do sound a little bit rough or different or weird. I am pretty rough this week. It's just a sort of bug that seems to be going around the UK at the minute. Thank you guys for watching, and I hope you have a blessed rest of your week. If you're interested in membership, make sure you DM me the word discount, and I'll sort you out, guys. Let's get it.